Do you know why the communist leader in China has banned Bitcoin and why they don't follow any speculation around it? Well, like what you hear or not, it's certainly the correct pathway. Investing money in Bitcoin is at the top of many to-do lists out there, but there is someone who stands firmly against this notion. Charlie Munger is the Vice President of Berkshire Hathaway and the right-hand man of the legendary investor Warren Buffett. And he thinks that crypto is undermining the world currencies and it is evil as well as delusional. It's human nature that people always seem to follow speculation and are attracted to things that are glowing and fascinating. Well, according to Munger, evil's doing its thing. And guess what? It is playing with your hard-earned money this time. You will have a different mindset about crypto by the time this video concludes. This video is a must-watch all the way, regardless of your attitude regarding cryptocurrencies. Sometimes we get overwhelmed by popular opinion and are forced to follow what everyone's been doing. This video is some piece of wise advice by Charlie Munger on whether crypto's a buy or not, so stay put because you don't want to miss out on this. Welcome to 5-Star Finance, the place where we teach you how to achieve financial freedom. The fact that we're talking about clever computer science doesn't mean that crypto will pull off wonders for you. There's this thing about non-productive assets that they're not providing you with anything. And to make things worse, you're dependent on other people to make your money. Crypto has taken the world by a surprise during the last few years. Well, to put first things first, if someone comes up to you and says that that's a big time buy, you should put your savings in it, simply say no. According to Charlie Munger, crypto is an investment in nothing. Furthermore, the 98-year-old stresses that he would never in his life touch them. Cryptocurrencies have no unique value at all. No doubt that blockchain technology is important, but Munger is quite certain that it will come to a bad end. For example, when you invest in quality stock, you're actually buying into the company, and now you can expect your share to rise as the stock prices go up. And you may well receive stable dividends if you've your money invested in one of those dividend stocks. Similarly, when you buy a farm, you look at the crop every year and you consider the prices, then you make a decision if it was a good investment or not. So actually, you're looking at the asset itself and what it is producing for you. Bitcoin, according to Munger, is bound to end badly. For how long can the speculation continue? On one side, Munger has compared Bitcoin with turds. There are people on the other side willing to bet their houses on crypto. Now, why is this happening? Why do people like to become the architect of their destruction? Well, there's a well-known analogy underneath. According to Lemming syndrome, people tend to follow what their peers are doing. Many psychologists have proved that people naturally follow the larger group instead of going through independent risks. This phenomenon is known as the Lemming syndrome. This is derived from the popular myths of rodents called lemmings found in the Arctic region that are supposed to follow herd behavior. They follow the behavior of their peers even if they lead them to death. So if people see their peers jumping off the cliff, they tend to jump off too. This is why people are attracted to crypto's upheaval. They like to follow popular opinion, and in that process, they usually ignore the rational thought process. When you buy a business, you look at what the underlying business model is and how the business model goes about its working and what money they're earning. But in this whole scenario, you've maintained the principal asset itself. It's the additional income you're worried about. After investing in such assets, you don't only have what you bought in the first place, but you also have what the asset produced. Now, this is the problem with non-productive assets like cryptocurrencies. When you buy, let us say Bitcoin, all you're depending on is whether the next person is going to pay you more because they're even more passionate as well as excited about another next person in the line coming along. But deep down, the asset is creating nothing itself. In crypto's case, it simply does not generate any kind of cash flow. Now, being a traditional value investor, you should always consider a cash outflow to be an investment, and it always produces cash inflows in some months or years to come without the need to get rid of the asset itself. For example, if an investor buys equity shares in some business, those shares will produce cash flows in the form of dividends, and similarly, if you buy a house, you can generate some serious cash flow in the form of rent, but you are not selling the underlying asset. Another flaw can be the unavailability of tangible assets because cryptocurrencies are simply not backed by tangible assets. Now, most traditional orthodox investors believe that cryptocurrencies do not make good investments, and one day or another they're bound to end miserably. However, they also believe that crypto will not make good currencies either. Currencies need to have an underlying value if they're to be effective, which you're not getting with crypto. Historically, gold and silver have some underlying value because they were considered to be precious metals, and they emerged to be currencies in almost every continent throughout the world. Now, similarly, fiat currencies are generating their value from the government. It is simply banned or illegal to not consider these currencies in the country where they are issued. With cryptocurrencies, there is no underlying value, decree, or source from which they can derive their power. Another reason why traditional value investors are not standing with crypto is that they're not stable. Now, we all know that currencies fluctuate in value. The reason is that the amount of money in circulation keeps on increasing or decreasing in comparison to the assets in the underlying economy. Now, for example, the United States dollar loses around 2% of its underlying value each year due to the ensuing inflation. And truth be told, this is quite normal for all currencies. With crypto comes some serious trouble. They take this instability to a whole new level. For example, it is common for crypto to lose 30% of its value over the weekend. Now, in the past few years, crypto has been extremely volatile. They have simply quadrupled in value, only to come down like some comet and then rise again. And the interesting thing is that the depreciation takes place due to some meaningless events, as it happened when Elon Musk tweeted negative comments revolving around cryptocurrencies. A lot of these currencies lost 30% or even 40% of their value. This level of instability is not productive at any level, and hence cryptocurrencies are not and cannot be considered good investments. Another factor about cryptocurrencies is that they cannot be predicted. You can at least have some calculation or some strategy when you're dealing with stocks. For example, you can look at the market cycles to make your investing decisions, but the same is not true with crypto. Movement in their value or price does not follow any pattern. On the other hand, stocks seem to have a direct relation with the GDP of a country. With crypto, the movement is quite random, which makes it vulnerable to all sorts of problems. So what is your opinion about Charlie Munger's advice on crypto? Are you still going to bet everything on crypto's upheaval? Or are you going to play it safe and depend on productive assets instead? Let us know in the comments section below. Investing in non-productive assets can bring about many problems for traditional investors in the long run. This is why Charlie Munger has termed crypto as some sort of rat poison. However, investing in the stock market is far more productive than crypto in every sense. You can receive dividends in the long run, and your stock price can also grow in value if you're making your investments with certain research following. For that, it is very important to understand some stock categories. This is the reason we've provided a free ebook in the description below, which will explain the 6 stock categories in detail. Check out the video we handpicked for you, and we'll see you in the next one.